Right. I think we got some people starting to come on in here. Welcome, welcome, whoever is attending today. We're so stoked to have you. We'll give everyone kind of a few minutes to kind of funnel in here for today's webinar, and we'll get started in just a few. So yeah, we'll hang on. And by the way, while we're kind of getting going here, feel free to drop in the chat where you're from, what your favorite food is, something cool that we all want to hear about. So yeah, let us know where everyone's kind of calling in from, so we can get a feel for how global we are today, I guess. I'm from Louisville, Kentucky, born and raised, also where we're headquartered here at Forecastr. And then yeah, Graham, you were saying you're from South Africa, correct? In Cape Town?
Absolutely. I wish I could say sunny Cape Town, but today we're in the middle of a bit of a tropical storm. But good to be here, and yeah, looking forward to the chat.
Fantastic. Awesome. We'll give everyone just a couple minutes here. And for those who are in here right now, by the way, feel free to use the chat and the Q&A as well today. As we're going through this, I know Graham's kind of got the scheduled programming for us today, but we're gonna have some time at the end for some questions and whatnot. As we're going along, feel free to hit us up in the chat or the Q&A. I'll be kind of monitoring that, making sure everything's good to go there. And we can kind of get to some of those questions maybe as we go along or at the end as well, so we can get everyone's question answered. So. And by the way, for those who were expecting the celebrity, Jeff Erickson, he is unfortunately unable to make it today. My name is Brock. I'm a senior account exec here at Forecastr. So I'm filling in for him today, kind of helping host today and make sure everything goes off smoothly and make sure we get all your questions answered as well. So
We might not have Jeff, but we've got the ping pong champion. Yeah, so it's a good
yeah,
substitute.
he's on 2023 there. So we have our company on site every year, which by the way, if you're a founder out there and you're starting to build a bigger team, definitely do on sites where everyone gets together in one location. If you're fully remote, it's super great for team bonding. I lost last year's or this past year's competition, so I'm really riding that 2023 high at the moment. Yeah, Graham. Awesome. And then oh yeah, Ray, what's up, man? How's it going? Yeah, he's calling in from San Francisco. Good stuff. Cool. Well, I think we got probably enough people on here to kind of get going and have enough of a quorum. So, yeah, well, welcome to today's webinar. Today, and let me get the slides pulled up here for everybody. Today, we have a very esteemed guest with us, Graham Stephen. He's with bizval. He's going to be running us through essentially the business valuation masterclass. So kind of how to increase the value of your startup. So he's got some really cool stuff for us today. I'm going to kind of turn it over to him, let him take it away. We'll do kind of some sponsor shout outs at the end from bizval and Startup Stack and obviously Forecastr as well. But we'll let Graham kind of run with things. And yeah, again, feel free to hit up the chat or the Q&A with any questions you might have. So I'll turn it over to Graham and let him kind of run with things.
Fantastic, Brock. Thanks for the intro. And there's no pressure. I've got some people representing Silicon Valley here, so I really got to up my game. But wonderful to be here. It's 6 p.m. in the evening here in South Africa, so you know, getting close to wine o'clock and beer o'clock and whatever you guys call it in the States. But today, I think, Brock, if you maybe want to just pick through the slides. But I think for today's agenda, we're really going to chat about, you know, what are the things you need to think about in terms of increasing the value of your startup. And I use the word startup quite loosely. I mean, the reality is, you know, everyone thinks startup and they think, you know, Uber or Airbnb and the sort of like unicorn thing. But the reality is, you know, 90% of startups are not that. And, you know, together with Forecastr, we love working with those kind of founders who are getting out, they're starting, they're grinding, they're building businesses. And we like to keep things pragmatic. We like to keep things simple. You know, at bizval, we're a startup ourselves. We're only 2 years in, and we work with, you know, founders, with intermediaries like Forecast are working with founders, helping them understand the value drivers of their businesses. So we just love sharing and engaging with other founders. So I think in terms of today's agenda, Brock, if you just want to click through, we're really going to talk about a little bit about understanding startup valuation and why it's important. Building for value from day one. I think this is a mistake a lot of people make. They think, well, you know, we'll create value sometime down the line. But I think particularly post 2020 and COVID and changes in interest rates and inflation and that, understanding how you build for value from day one is absolutely critical. how you calculate your company's value. I mean, it might sound simple. We'll touch on that. We're going to touch a little bit on high growth companies versus traditional SMBs. So there's a lot of similarities, but there's also some differences. And we'll talk a bit about value drivers and detractors. So that's really the agenda for today. We don't have, it's a topic we could probably spend a day masterclass on, but we've only got, let's call it 30 minutes to chat and then some questions. So we'll keep it brief. If there's any questions, we don't get to them in the webinar, just drop us something in the chat and we'll connect afterwards, and happy to connect with any of you. So Brock, let's get going. I think the first question is a very obvious one, is, why is startup valuation important? A lot of the time people think, oh, you know what, I'm not worried about my valuation. I'm going to go raise money. And, in the sort of traditional VC world, a lot of VCs out there don't worry too much about valuation. Part of the reason for that is, it's like an option. They're looking for 1 in 100 businesses that hits it big. And, that view can sometimes be a bit misleading and create a bit of a distortion. But I think as a founder, it's really important that you understand your valuation, whether it's raising equity, whether it's selling a business down the line. One of the famous VCs always said he's not worried about valuation when businesses are raising, but he's worried when he gets to sort of Series C, Series D, and the sort of private equity and the suits come into the room, and they really want to understand the business fundamentals. And I think the view we take is, don't wait until you're at a Series D, Series C before you start thinking like that. Think about that from day one. Managing for growth. And, there's a bunch of other use cases. So share option schemes, company share option schemes, ESOPs, as you might call them in the US, insurance and all these sorts of things. Even basic things, startups, we often don't think about key man insurance and buy-sell insurance, but those things are important, and it's important that you think about those from day one. So if we move on, let's talk a little bit about what are some of the sort of key considerations that you need to think about that can increase the value of your startup. So in simple terms, a valuation is a summation of future cash flows. So in other words, how much cash profits, can a business generate at a point in the future? So it's a function of growth and risk and reward. Now, a lot of people will say, oh, but it's a revenue multiple, and we'll talk about that just now. Or don't worry about that. Don't worry about the future cash flows. But ultimately, something has value if it creates future profits, or current and future profits. So that's the first principle that we want to talk about. The second thing is that valuation is not a precise science. Okay, I like to say it's a craft and a science. Some people say an art and a science. I've heard that one being attacked a little bit. But the reality is, there's some fundamental principles about how to value a business, and there's also a bunch of unknowns. So there's no right answer, but there's usually a range of outcomes which are sensible, both from an investor point of view and from an owner point of view. Just going back quick, I think we've moved on a bit quickly. And in high growth businesses, which startups typically are, you often find the situation, as I touched on earlier, where investors kind of base their valuation on, how much equity is needed to reach the next funding milestone. Okay, so, I won't use the word Ponzi scheme because it's not, but there are parts of the, I see Brock's having a bit of a laugh there, he's on mute, but, there are parts of the sort of early stage world where it does feel a little bit like that. You get in early and you get out before the house of cards comes tumbling down. Now, obviously, we don't want that to be the case. No founder wants that to be the case. And I think being empowered and being informed as to what the real value drivers are helps you avoid that situation. And then I think there's some factors that founders need to be aware of. Often they'll go into valuations, and it's a common trick of guys wanting to get in early on a valuation. They'll offer this monstrous valuation to buy into your business. And then hidden in the fine terms are all sorts of clauses around shareholder dilution, and I've seen too many horror stories where founders actually eventually, after 2 or 3 raises, lose control of their business and they walk away with nothing, and preferential rights and all those sorts of things. So these are all elements that a founder needs to be aware of. and they need to, they can't be naive to them as they're building their business. Because believe you me, there's plenty of people there who see something and essentially want to hijack potentially successful businesses out from a naive young 25-year-old founder's hands. And we can't be naive about that. We like to think everybody has the best intentions, but the best way to deal with that is to be empowered and educated as a business founder yourself. So, Brock, let's move on to the next one. So I think there's sort of 5 key principles I want to talk on, and these principles are universal. They apply whether you are a a startup, an existing business, and I think the best businesses and the best founders try to build this into their business from day one. Obviously, there's a stage when you're very much around experimentation, trying to find product market fit and all those good things. But the first one is really obvious, is around owner independence. Whilst investors love to say we're backing the jockey, okay, I'm sure you guys have heard that term. Who are the people behind this? What are they doing? That's true to an extent. But at the end of the day, there are some exceptions when it comes to personal branding businesses and all those sorts of things. But if the business can't in time run independently of the owner, it's a big issue. And a lot of successful multiple startup founders realize this, and they build their businesses like that from day one. So they build an effective delegation, they build the right team around them, and most importantly, they build effective and scalable processes and systems. We've just gone through this with our business. Typical founder, I don't want to spend money on a CRM system and all those sorts of things. We can handle what gets thrown at us. But as one of my mentors once said to me, he says, you're not going to die from having enough leads. You're going to die from indigestion. And what he was basically saying is that you switch on Google AdWords or you get your SEO right, and suddenly you've got too many leads that you can handle coming through the door. So having scalable processes and systems, it doesn't mean you need to go and design the Rolls Royce of CRM or finance systems, but you've got to have a system which can grow with you as a business and be robust to do that. And usually simple is better. It doesn't mean you've got to overcomplicate it. So that's really, really important. The owner independence and the second point around scalable processes and systems go absolutely hand in hand. And that's where the likes of the Forecastr guys and that, with their financial modeling, their financial, fractional CFO kind of stuff can really help in terms of helping founders, certainly from a finance perspective, understand some of those things. The next one, again, is really obvious, and this has become even more apparent since, well, actually, I say it's not always obvious. It's become a lot more apparent pre-2020, pre-inflation rising, post-inflation rising, and post the cost of money rising quite dramatically, is that, prior to that, it was like just grow, 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 and worry about profitability later. And fundamentally, you've got your operating costs, but your unit economics of your product have to be able to stack up, not just on day one, there's experimentation phase, but a business with strong unit economics, strong margins, is always going to be preferable to one that doesn't have strong margins. So this also talks to having, what we call moats around your business. You can only have strong unit economics if you're priced appropriately and you've got, let's call it, either real barriers to entries, we'll talk a little bit later, like things like IP protection and all those sorts of things, or barriers to entry like, great customer service that nobody else can replicate. So, strong unit economics are absolutely critical. I see there's a question from John. John, I'll tackle that a little bit later. That's all right. Is there, what is considered a strong margin? That's a bit like how long is a piece of string? It does vary by industry. If you're in a service industry, software as a service business, you could be in a plumbing business. There's no right or wrong answer, and it can vary wildly across businesses. But look at what your competitors are doing. Look at what the market's doing. Look at customer price points. Understand that. We often see founders who come in and they're new to market. They've come in with an innovative new product. And one of the mistakes they make is they assume that those strong unit economics are always going to be in place. So they do a 5-year projection or forecast, and they assume that they're going to be able to maintain 100% margin. And they wrongly assume that there will be no competitors ever entering the market. There'll be no price pressure. There'll be no evolution. Um, so those are some of the things you need to think about is what happens down the line. Okay, what happens when competitors come in? If you invent something really great, you're not going to be the only one. Somebody else is going to copy you, and it's a matter of time before those margins start to come down. So strong unit economics, really important factor. And then the last two, again, go hand in hand with each other. So robust understanding of customer. And again, it might sound like a very generic motherhood apple pie comment, but a robust understanding of customer and having a big enough market to achieve a desired exit outcome. So you might understand your customer well. You might understand their pain points. You might understand their needs. But ultimately, you need to understand what influences their buying decision, and is that market big enough? Now, if you're sitting in the United States, it's very seldom an issue. Typically, I'll give an example. A state like Texas, for example, has probably got a bigger GDP than most European countries. So in the States, you've got some things there around being hyper focused, hyper niche, all of those sorts of things. That's not true in every single country in the world. So maybe it's not something you think of automatically if you're sitting in the US. But it is something when you move outside of the US and people think, oh, I'm going to take this product global, I'm going to take it to other countries, which is something you really need to think about. Is that market big enough to sustain what you're selling? So these are the sort of 5 core building blocks that we like to talk about in terms of building a valuable business. And as a founder, to take a step back and think back to these sort of first principles is always really super, super powerful. Your financial model is critical to all of this. So I think you don't know all the ins and outs, okay? But understanding what your key value drivers are and how those move in sync with each other is super, super critical. And again, that's why we love working with the Forecastr guys, is because that's where their bread and butter and their expertise is helping you as a founder understand what those levers are. What are fixed costs, what are variable costs, and how do those things change as the business scales. And that's one of the first things we do is if you've got a financial model, we then dig a level deeper and say, well, what is the business model that underpins that financial model? So, this is a very high level overview in terms of the sort of basic building blocks of value, but I think it's a good foundation from which to start. So, Brock, maybe if we can move on. I don't know if you want to add anything in there. So you've taken yourself off mute, but
Yeah, just
feel free to
really
jump in if you've got
quickly.
a comment.
Yeah, it's very common for people to say, "Oh, I want my numbers to be right." That year 5 revenue number has to be correct. Spoiler
Yeah,
alert, gang, like everybody knows it's all guessing, right? Up until like a Series A, Series B funding round, that's when the numbers start to get real. So what we focus on
yeah,
and what, anyone building a financial model in general should focus on is like the structure, like the logic of how you're thinking about business growth, which like you said, Graham, builds that strong moat. Like, hey, we have everything in place. The numbers will come later. So yeah, I think that's a really great point that you just made. So yeah, let's keep it moving.
yeah. And I think on that as well is just, we'll talk about it just now, but we talk about sensitivity analysis, so what happens if growth goes from 25 to 50%, or what happens if it goes the other way around? Understanding those sensitivities and the directionality of them is far more important than the absolute number. So I want to talk a little bit about, what we call beware the revenue multiple. Okay. This might be sacrilege in startup world, but you know, everyone's like, well, this industry or this sector or software as a service business, the market's trading at a 10 times revenue multiple. Okay. Now, when we start talking about multiples, whether they're revenue multiples or whether they are profit multiples or EBITDA multiples, all those different things, what I always say with a multiple is it's an output based measure. Okay. There's a market measure and there's an output based measure. And I'm talking to a US audience. It's a bit like saying, we're going to put 5, 6'3", 250-pound men, stand them in a line and assume that they're all going to play, offense for the Green Bay Packers or San Francisco 49ers or whoever you support. Okay. The reality is some of those guys might just be, overweight big men. Okay. Some of them might be football players. And that's the danger with multiples is they definitely have their place, but you've got to interpret them with caution. So, you've got to look from the other way around and then say, actually, how do you get to those multiples? The things that they fail to do is they fail to adjust for changes in jurisdiction, US versus Europe, changes in macroeconomic conditions. So, just look at what happened to valuations of the likes of, we're on Zoom now. Zoom in the COVID period when there was a sort of like free money, everyone flooding to online meetings. I mean, it went through the roof. And look where the valuation is now, So multiples aren't particularly responsive to those kind of things. And, often in private businesses, there's a limited data set. So again, in the States, sometimes you have got more databases that you can do a lot of those sorts of things. But smaller businesses, you can't take a multiple from an NVIDIA and apply that to your little startup that's making, I don't know, computer chips for calculators, for argument's sake. It's very dangerous to apply that. So we say beware the revenue multiple. Nothing wrong with using them, but use them with caution and understand that it's a reference check rather than an input measure. So Brock, maybe move on to the next slide.
Yeah, and something real quick to add too, it can be a tricky game, saying, hey, this company raised this based off that. I can do the same thing because I'm in their space. We hear that a lot.
Yeah,
We always kind of err on the side of caution of, well, let's build the model. Let's make sure we understand your business first. So yeah, great point about the dangers of revenue multiples for sure.
exactly. And like a lot of that is also, you got to understand who the founder is and what the experience is. And Jeff's not on the call, so I'm not going, I'll use his name in vain, so to speak. But, if Jeff is founding a business, multiple successful founder, investor, exited multiple businesses, Jeff might get a 10 times revenue EBITDA multiple, but somebody else who's a 23-year-old, what's it, sophomore, freshman, or whatever, just left uni, it may not get the same thing, even with the same idea, so got to apply that with caution. I guess there's three main methodologies. I'm not going to get too technical on this, but we've spoken about this. Your discounted cash flow. That's our preference for when we think about valuing businesses and startups. Okay. And it's not a precise science, but understanding your growth rate, the discount rate you use, for VCs and funders, they will often look at what is their required rate of return on their fund. So when we talk about them wanting a 10x return, it means that within 3 to 5 years, they want to 10x their investment. By implication, you can work backwards and understand what their required rate of return is. Okay, so in startup land, those returns can be required rates of returns can be north of 40-50% per annum. Okay, and that kind of works in the opposite way to growth. Okay, so the more risk there is, the higher the required rate of return, and different investors might have different risk appetites. So two investors might look at your business. One might have a high risk tolerance, another might be a little bit more cautious, and they can have two completely different valuations on your business. Which is right, which is wrong? Well, neither. But you as a founder need to understand what type of investor are you dealing with. Okay, so how to negotiate and engage with them. I see there's a question from John, and it just dropped off the screen, but I think it was around how do you determine what the right discount rate is to use. And again, there's no right answer. The way we look at it typically is we start from the bottom up. So when you look across different countries, jurisdictions, we start with a risk-free rate of the country. We add on a private company discount. We then look at the industry, the sector, the experience of the founders, and the kind of risk associated with the business. It's a sort of a bottom-up approach. And then we also look, at what is the going sort of required rates of returns of investors and founders and funders. So there's a multitude of different ways that you look at it. As I said earlier, what's a really useful technique is to understand those sensitivities. So if we value a business on a discounted cash flow, we will always say, well, let's say your base rate is 40%. I'm using a number. Okay. what would the valuation be at a 30% discount rate, and what would it be at a 50% discount rate? So understanding that is really, really important. I'm not going to dwell on enterprise and equity value. Suffice to say, enterprise value is effectively looking at the business without considering what the capital structure is, so how much debt and how much equity is in the business. Whereas the equity value looks at the business from what is the equity worth. So if it's a leverage business and you've raised debt to help fund the business, you can create leverage in equity value. It's probably too technical for today's discussion. Multiples I've spoken about, so often in startup world, we talk revenue multiples. If you're going to insist on multiples, I would say understand what your EBITDA, or earnings before interest and tax multiples are. Okay. And apply sensible adjustments, so, you might be a founder and you're not paying yourself a salary. Okay. But if somebody else is going to acquire this business, they're going to have to put an operating and then pay them a fair market salary. So there's certain normalization adjustments that get made. But, if you're going to do multiples, look at your EBITDA multiples, and not necessarily in year one, because in year one, your business is probably in the J curve. It's not making profits. But have a look at what your profit looks like after 5 years. Okay. And apply a multiple to that and then discount it back to present time. So there's different ways of applying multiples. Again, it's usually a sanity check rather than the core methodology. And then the last thing is net asset value. This is more in traditional businesses. It can also be the case in tech startups. Very seldom happens, but capitalizing IT costs and development costs versus expensing them. But in certain industries, mining industries, like mining startups where there's heavy, infrastructure and investment in assets, it's something that you need to look at, because some businesses are worth more dead than alive. So if it's a very asset intensive business, you might be, and you can't make this thing profitable, you might be better off selling off the assets and effectively doing something else. So these are just the methodologies we look at. I'm keeping a half an eye on the time, so I know I've got probably 5 or 6 minutes before I need to wrap up for questions. So let's move on. This slide, again, I'm sure we can circulate the slides afterwards, Brock, but I just wanted to touch on very briefly, I've said high growth company versus startup, and this is important because we just try to break down some of the differences between a 10-year-old family business that you're looking to exit versus your growth business that you're looking to fund. And from reasons to valuations, they can vary somewhat. In an established business, more around exit planning, estate planning, insurance, whereas for your startup, it's more around fundraising, staff incentive schemes, all of those sorts of things. And you'll see it's just a continuum. So, when it comes to risk, startups are generally higher risk, limited track record. Traditional SMBs usually got a track record, it's a known quantity. So immediately you would say, okay, well, if it's higher risk, your required rate of return might be higher versus an SMB. So it's a useful framework to go through this to kind of say market size and potential, all these kind of things. When somebody's saying, well, why is an established business that's been going for 10 years, trading at X multiple, and I just said I don't use multiple, versus a startup, it's because of these kind of factors. And when you value a startup business, you need to go through each of these and really interrogate them and understand them. So with an established business, you've got the track record to be able to go and say, oh, it's done this for the last 10 years. I've got a track record. With a startup, you've actually got to spend a lot of time with the owner and the founder and the founding team, unpacking all these different elements. This is something that actually happens not just at the valuation phase, but at the financial modeling phase. And I'm sure Brock will jump in here and say when they go through a financial modeling process, these are the kinds of things they spend a lot of time on. So let's move on. I see there's lots of questions, so I want to make sure I leave enough time for that. Okay. Very briefly, value drivers and detractors, the things on the left, and you'll see some things on the left that are also on the right, but your value drivers are the things that increase the value of your business. And I always say to founders, focus on these 6 things, okay, in terms of increasing the value, and try and avoid the ones on the left. Okay, so strong growth rate, absolutely. cash conversion. Don't think about that too late. Okay. Ideal world, strong growth and good cash conversion of profits. IP and trade secrets. I've seen this so many times. Guys build a wonderful, and they forget to file the patent, or they don't go and protect the IP. It's not a difficult process, but if you think you've got a great idea, take the time to go and register the trademark, register your web address or your domain. Okay, it's very hard to change that 2 or 3 years into a business. They're not particularly costly, and sure, if you go onto the Startup Stack platform, there will be guys that can help you with those sorts of things. Recurring revenue, that's the what do you call it, the silver bullet, so to speak. Everyone wants subscription based revenue that you wake up on day one of the month and you don't have to sell anything because it ticks over. But it's not always possible with every single business. But I think the mindset of thinking about recurring revenue. So for certain businesses, the bizval business, for argument's sake, our recurring revenue doesn't come because we have a subscription. Our recurring revenue comes because the people who work with us realize that there's value in this, and they come back at the end of the year when they're doing their review or their next fundraise. So it's about keeping your customers satisfied, and word of mouth and Google reviews and all those good things. And then things like geographic footprint, and customer dependency. So if you've got one big customer, let's say serving the US State Department or US military or whatever it is, and you lose that contract, your business is in trouble. And this applies, so think about diversification. Don't turn down the big contracts. But I see a lot of startups land a big deal with a Walmart or an Amazon or whatever, and they think they've got their ticket. And that's the thing that ends up breaking them, because that one big customer becomes their sole focus and they lose sight of the rest of their business. So those are the value positives. Focus on those things. And the negatives, I guess, are basically the inverse of those. So things like cost of build versus buy. When you're looking at things like systems and processes, rent the things you can. Rent your CRM system. Don't go and build those things from scratch. The last thing I just want to touch on is inconsistent financial results and poor growth rates. So everyone accepts that a startup is going to have waves. You build a business in waves. It's not just a straight line to the top. If you're going skiing in Utah, it's like you're taking the cable car to the top. It's like you're hiking to the top of the mountain. Okay, there's ups and downs and nooks and crannies and all of that. But having said that, directionality needs to be important. And it's important that this stuff is recorded and tracked correctly. And you can explain those variances. A lot of startups don't worry about the counting. They just make sure they're doing okay with their tax and their VAT or their state taxes. But make sure you get your accounting and that right from day one. And again, that's something that the Forecastr team can help with. Brock, you want to jump in, and then I'll wrap.
Yeah, totally. I just think something that a lot of people do it, but we live, breathe, and die by it is OKR setting. And if you're unfamiliar, OKR stands for objectives and key results. And this is a way to essentially track the consistent results and like the growth and just the things that are kind of less tangible around the business, right? You can obviously track your numbers very easily in a financial model, but understanding like these kind of milestones that you're hitting is super important, and then communicating that to your investors or whoever's on your cap table as well. So something to look into if you don't really have a way right now that you're kind of tracking your goals and then your results from those as well.
100%. Cool. So let's move on. I think the next slide you can kind of skip through. I mean, this is not a bizval sales pitch. I mean, we really are just to kind of share info. But the reality is if you are a founder and you're saying, hey, how do I go on this journey? bizval's created for that. You're not going to pay $20,000 like you would at a Big Five audit or CPA firm or whatever. We've kind of priced to be able to help founders on that journey, and we entrepreneurs and founders ourselves. And our mission is really to make accessible to founders quality, practical, useful insights around valuation and the drivers of valuation to help you do that. So that's all I'm going to say on bizval. We work with founders. You hear about the strange accent. I might be based in Cape Town with great weather, cheap food, and good wine, but we work with clients all over the world. I think to recap, Brock, and then we can take some questions, is I think just go into the next slide.
Oh yeah, sorry.
I'm going to talk about
yeah.
Very quick summary is if you remember 4 things from today. is remember valuation is essentially a function of risk and reward. Okay. How certain are your future cash flows and how much can they grow? Okay. Don't buy into the hype of, you know, that you see in the media and the hype that often, you know, the VCs will push, and, you know, just be wary. Don't be naive. Okay. So understand all these things, because believe you me, the savvy financial investors are doing this. The VCs are doing this. Okay. You know, it's not their first rodeo. A lot of founders, it's their first business, second business. So by educating yourself on this, at least you stand a chance in having conversations with investors. The second one is start with that end in mind. It probably sounds like a Stephen Covey testimonial, but you know, and what that means is understand your unit economics, understand your growth and market potential, owner independence, those key drivers we spoke about. Think about those from day one, not, oh, I'm going to grow and scale rapidly, and I'll think about those down the line, because it seldom happens. Okay, so think about those from day one. Understand that high growth companies have got some unique, or startups have got unique characteristics relevant, you know, relative to standard small businesses, SMBs. Okay. I think also the one thing, I don't know why if it fits in there, but I mean, the emotional aspects are something important to understand as well. Okay. So, you know, the intensity that gets put into building a startup, sometimes you can get wrapped up in that emotion. SMBs have got different emotional aspects, but just understand some of the differences there. And the last point, I say this all the time, is the valuation drivers are more important than the number itself. So focus on the basics. And I'll use an analogy over here. You know, if you want to be fit, you know, you look at what's happening to your VO2 max trend. Is it getting better? Is it getting worse? You know, is your average heart rate increasing or is it dropping? And what are the drivers behind that? You know, are you eating well? Are you sleeping well? Are you exercising well? And building a business is no different. So, you know, if you're listening in onto this webinar, I guess you'll see there's no real rocket science in here. And in fact, the businesses that get this right and get those valuations and they get the exit, not just the paper valuation, normally have these things in place. It's all very well having a unicorn status and a paper valuation. And then when you get to actually trying to sell the business or exit down the line, you know, these things aren't in place. That's when it comes crumbling down. So yeah, that's really, you know, what I wanted to say from the formal section. I guess we've got some time for questions. I'm not sure we're going to get through all of them, but Brock, I'll maybe ask you to pick a few and we can put me on the spot.
Well, and before we jump in, just a quick shout out to like some of our sponsors and stuff. So
Yes.
first of all, a huge shout out to Graham. Thank you so much for coming in here and you know, giving just some powerful stuff today. I know I'm a former founder and it's always super daunting, like doing some of this stuff alone. And so we have partners that are here to help. bizval is definitely one of them. Go check them out. Valuation is, it's not an easy task to do, but they're going to be right by your side and helping out. And we are here at Forecastr as far as financial modeling wise. Like as Graham kind of alluded to earlier, you need both. Like one kind of feeds into the other. So we'd love and be absolutely honored to help be a part of your journey and build you just a killer financial model to go fundraise with. If you attended today, you see you get a 20% off discount working with us. I'm going to throw the demo link here in the chat. So feel free to click on that, go grab some time either on my calendar or one of the other awesome Forecastr team members here, and we'll get you hooked up in the right direction, get you a killer finance team. Also want to give a special shout out here to Startup Stack as well. They are one of the sponsors of today's event. Startup Stack is incredible. If you don't know where to go for the right connections, go hit up them. They're going to be able to help kind of put you in that right position to talk to the right people. Their whole goal, and I know Jeff was kind of helped with the inception of Startup Stack, but their whole goal is to find you the best discounts possible for all the things that you could need to start your business appropriately. So great guys over there at Startup Stack. Jonathan, I don't think he can make it today, but I'm sure he sends his wishes as well. And obviously, go check out bizval. They're going to give you everything you need on the valuation side. And yeah, Graham's been incredible today. So that being said, let's open it up to some questions here. I know we had a few in the chat. Just a real quick one from John. He was wondering if cash conversions are the same thing as gross margins, Graham. I don't know if you want to touch on that real quick.
No. So, I mean, there's a link between the two, but it's not always exactly the same thing. Okay. So gross margin typically looks at this, that sort of top trading line. So if you're selling a widget, what is your selling price versus what is the cost of producing that. I mean, that's typically your gross margin. But then there's also your operating costs that come below that, so you're paying for salaries, you're paying for systems, you're paying for rent, you're paying for all of those sorts of things. And I know I'm using very simple terminology. Um, and then your sort of non-cash items, so things like depreciation, amortization of software investment, and all of those sorts of things. So normally those are the things that we would actually kind of add back. Your cash conversion is really that bottom line in terms of that. I know a lot of startup businesses do. Fundamentally, they'll look at the cash conversion on the top line on gross margin. Okay. And that's a useful metric to look at, particularly if you subscale. Okay. Because, and it's important that you track that metric. When we talk cash conversion, this is actually bottom line, normalized, not all funky adjustments. Okay. Putting in a proper salary for the founding team and all those kind of things. Profit before or after tax. It just depends on which view you take.
Yep. Awesome. Good stuff there. And then another quick one. Gilbert was wondering earlier, like, do you have like a template or something that they can use to get started with? Like, are there some resources that bizval might have for folks?
Yeah. So Brock, I mean, so for established businesses, I mean, you can go and check out, we've got sort of an online platform that you can go download the value creation starter pack. That will give you a good idea of the things we ask for, but slightly more established businesses. Now, we try to build something like that for startups. And to be quite frank, it didn't work. And there are tools out there. There's some great resources where you can do an online startup valuation. And not knocking them anyway, but we actually found that in the startup space, you need to go through that process. So if he's got a question, I'm more than happy to take you through sort of our fundamentals. We've got stuff that I can share with you over email. You're not going to find it on the website. But we have got some resources and PDFs we can share in terms of how we think about the startup journey in a little bit more detail. And, feel free to, if you want to schedule a half an hour, one-on-one call, very happy to address any of those sort of direct questions, and we can take I forgot the name who asked the question, but we can take them through that.
Yeah, Gilbert was wondering about that. So yeah, Gilbert, if you're listening still, yeah, go check out bizval. They can help you out for sure. And very kind of you, Graham, to offer your time for sure. We got maybe just a few more minutes here for a couple more questions. I thought Mary had a good one in the chat. So she was wondering about like valuing patents or like a patent as a part of determining valuations for future investment or acquisition. And I'll just read kind of verbatim here something she said, like, including if we value the patent infringement, like even in a single market like the US, how do they do it? How do they find like the right patent attorney? So yeah, I don't know if you want to touch on that a little bit.
So Brock, you can get highly technical about this when you start getting to the world of patents and all of that sort of thing. So I'm not going to go the technical route now. But patents and goodwill and trademarks and all those sorts of things have got some of the same sort of fundamental principles behind them. Okay. And when you go back to first principles, we kind of say, is the patent something that helps you, okay, actually generate a future profit? Okay. So if by virtue of having a patent in place creates a moat that other people can't replicate what you're doing, or if they want to replicate it, they need to pay you a license fee and all of those sorts of things. That has got an economic benefit. So the way to do it in principle is to value the business, with a patent in place and understand what the impact of that patent would be on your economic fundamentals, profits, costs, all of those sorts of things, versus a business that doesn't have the patent, which means that margin comes down over time and competition is heightened and all those kind of things. So I know it's a very sort of simplistic sounding answer, but I think if you tackle it from that first principle approach, it's much easier to understand. I mean, each business is different, whether you're a software business, sometimes in software businesses, all you need to do is change one line of code and the patent is no longer relevant. So, there's no one answer, but from a principle point of view, Mary, hopefully that gives you some sort of, touch lines that you can kind of work with. And again, if you want to, more sort of detailed and comprehensive answer, very happy to jump on a call or respond by email. And Brock, maybe just to say that if there are any questions we haven't tackled, if we can get, the contact list, we'll gladly respond by email to every single question we haven't got to. And I think there was a question from Ray as well. Will the slides be available afterwards? We'll also send those out via email afterwards.
Fantastic. Yeah, Graham, super awesome. And wait, I love your take on like not getting too deep into it, but just kind of some food for thought on that subject because it can be quite a rabbit hole at the end of the day for sure. So
Yeah,
I
yeah.
think we're coming up on time here. I know we can't do a round of applause, but if you're in your home and you got free hands, let's give Graham a round of applause for sure for coming in here today and telling us a little bit more about kind of why valuation is such a big deal and how to go about it. Again, one more time, shout out to our sponsors. Shameless plug here for Forecastr. You get a sweet discount. We'd love to be a part of your journey and really kind of become that finance arm for you. I just put another link to grab a demo here in the chat. Feel free to do so. Another huge shout out to Startup Stack. Go check them out if you kind of want some sweet discounts or just don't know where to go and need a good place to get started. And obviously bizval as well. Thank you so much for hosting today. And yeah, it was incredible. We got people throwing some claps in the chat there. So Graham, great job today. And yeah, we'll see y'all next time. Feel free to tune in for another webinar.
Fantastic. Thanks, Brock. Thanks to the Forecastr team, and awesome.
Have a good one, everyone. See ya.
Ciao. Bye bye.